Welcome everyone. In last video we discussed IPO which is done in primary market. Today we are going to discuss the world of secondary market in the most simple language. In this video we'll explain secondary market, its purpose and how it works. So let's get started. The secondary market is where previously issued financial assets like stocks and bonds are bought and sold by investors. Unlike the primary market where companies issue new securities through IPOs, the secondary market is all about buying and selling these existing securities among investors. The secondary market provides liquidity to investors, allowing them to buy and sell their investments at any time based on prevailing market prices. There are various participants take part in the secondary market. The most common are individual investors, institutional investors, and traders. Individual investors like everyday people like you and me, while institutional investors represent large entities like mutual funds, pension funds, hedge funds, and insurance companies. Traders play a significant role in the secondary market as well. They engage in frequent buying and selling of securities, aiming to profit from short-term price movements. Most secondary market transactions take place on stock exchanges like the Bombay Stock Exchanges BSE or the National Stock Exchange NSE in India and the New York Stock Exchange NYSE or Nasdaq in the USA. We discussed exchanges in previous videos. You might wonder what these exchanges are. Well, these exchanges act as an organized marketplace, providing a transparent platform for buyers and sellers to come together and execute their trades. Now let's break down how the secondary market works with a simple example. Suppose you buy shares of company XYZ during its IPO in the primary market. Once the IPO is complete, these shares start trading in the secondary market. As an investor, you can decide to hold on to these shares for the long term, hoping the company's value will increase over time. Alternatively, if you want to sell your shares, you can do so on the stock exchanges at the current market price. The price of security in the secondary market is influenced by supply and demand dynamics. If more people want to buy a particular stock, its price will likely rise. Conversely, if there are more sellers than buyers, the price may fall. This constant interplay of supply and demand sets the stock's market price, reflecting investors' perceptions of the company's performance and prospects. So to conclude this video, we did an explanation of the secondary market and its significance in the world of finance by providing liquidity and opportunities for investors to trade existing securities. The secondary market plays a crucial role in the functioning of the financial system. If you find this video informative, give it a like and subscribe to this channel for more valuable videos like this. Thank you for joining us today and we'll see you in the next video.